It happens on a Tuesday morning. You are standing in line at the grocery store, or maybe you are at the gas pump. You tap your phone to pay using your linked line of credit, the same home equity line of credit, or HELOC, that you have used as your financial safety net for the last 5 years. It beeps. Transaction declined. You think it's a mistake. You check your banking app, you see the balance is fine. You see you still have $20,000 of available room. So you try again. Declined. And then you see the notification in your secure message center. It's a short, impersonal letter from the bank. It says, due to a reassessment of your property value and credit profile, your home equity line of credit limit has been reduced effectively immediately. Your limit wasn't just reduced. It was slashed to equal your current balance. Your available credit is zero. The lifeline you were relying on to pay your mortgage, to pay your bills, to keep your head above water in this economy, it has been cut. You didn't miss a payment. You didn't lose your job. You didn't do anything wrong. But the bank decided that your house, the collateral backing that loan, is no longer worth what it was in 2022. And just like that, the silent freeze has begun. Welcome back to Canada Property Watch. We have spent the last week exposing the insolvency of the Canadian banking system and the mechanisms they are using to trap your deposits. But today, we are going to talk about the other side of the war on your wealth. We are talking about the credit recall. While everyone is worried about interest rates, a far more dangerous phenomenon is sweeping across the Canadian banking sector. The banks are quietly, systematically, and ruthlessly freezing lines of credit and recalling HELOCs. They are de-risking their balance sheets, and you are the risk they are eliminating. Today, we are going to expose the demand loan clause that is buried in the fine print of your mortgage contract. The clause that gives the bank the legal right to demand full repayment of your HELOC at any time for any reason. We are going to explain how the Automated Valuation Models, AVMs, are secretly reappraising your home value overnight, and why millions of Canadians are about to wake up to a financial guillotine. To understand why this is happening, you have to understand what a HELOC actually is. Most Canadians treat their home equity line of credit like a piggy bank. They treat it like a second mortgage that they can dip into whenever they want. The real estate agents and the mortgage brokers sold it to you as unlocking your equity. They told you it was your money. They lied. A HELOC is not a mortgage. A mortgage has a term, usually 5 years, during which the bank cannot change the rules as long as you make your payments. A HELOC is a demand loan. It is a callable debt instrument. This means the bank retains the right to demand full repayment of the entire balance, or to reduce the credit limit to zero, at their sole discretion without notice. For the last 15 years, this clause didn't matter. Property prices only went up. The banks wanted you to borrow. They wanted you to be in debt. When they threw credit at you like confetti. But the party is over. We are now in the Great Devaluation. Property prices in the Greater Toronto area and Greater Vancouver are sliding. In some suburbs, they are down 20 or 30% from the peak. This creates a terrifying mathematical problem for the banks. Let's say you bought a house for $1 million in 2022. The bank gave you a mortgage for $600,000 and a HELOC for $200,000. That is an 80% loan to value, LTV ratio. The bank felt safe. But today, that house is only worth $800,000. Your mortgage is still $600,000. Your HELOC is still $200,000. That means you owe the bank $800,000 on a house worth $800,000. You have zero equity. You are at 100% LTV. To the bank's risk management algorithm, you are now a toxic borrower. You are a red flag. The algorithm doesn't care that you are a nice person. It calculates that if you default, the bank will lose money. So, the algorithm issues an automatic command. Cut the line. This is happening right now. We are receiving emails from viewers across the country. From Brampton, from Surrey, from Oakville, who are receiving these limit reduction letters. They are waking up to find their financial cushion has vanished overnight. But why now? Why February? Now 2026? Nah. It connects directly back to the technically insolvent video we released yesterday. The banks are hoarding capital. They are preparing for the loan losses from the commercial real estate collapse. Now, when a bank needs to improve its capital adequacy ratio, the amount of safety capital it holds, it has two choices. It can raise more money, which is hard when stock prices are falling, or it can reduce its risk-weighted assets. A HELOC is a risky asset. It is unsecured in the sense that if the house value drops, the HELOC is the first thing to get wiped out. By cutting your limit, the bank instantly reduces its risk exposure. They are shoring up their own defenses by stripping you of yours. This is the credit freeze we warned you about, and it is hitting the most vulnerable group of homeowners first, the extend and pretend crowd. For the last 2 years, thousands of Canadians have been using their HELOCs to pay their mortgages. Their variable rate mortgage payments skyrocketed, so they dipped into the HELOC to cover the difference. Or they used the HELOC to pay for groceries and gas because inflation was eating their paycheck. They were borrowing from their house to pay for their house. It was a Ponzi scheme of one. The banks allowed this because the equity was there, but now that the equity is gone, the banks are closing the loop. When they freeze your HELOC, they are cutting off the oxygen supply. If you were using that line to pay your mortgage and the line freezes, what happens next month? You default. This is the mechanism that triggers the forced selling wave. It won't be because people chose to sell, it will be because the bank removed the artificial life support that was keeping them solvent. Let's talk about the technology behind this. You might picture a bank manager sitting at a desk who is looking at your file and making a decision. That is not how it works anymore. It is automated. The banks use AVMs, Automated Valuation Models. These are AI-driven systems that scrape data from the real estate market in real time. Every time a house on your street sells for a low price, the AVM updates the value of your house. If your neighbor panic sells his bungalow for $800,000, the bank's computer instantly assumes your bungalow is also worth $800,000. It recalculates your loan-to-value ratio. If that ratio crosses a certain threshold, say 65% or 80%, the computer automatically triggers a limit reduction on your account. It is a silent execution. You don't get a phone call, you don't get a chance to argue. You don't get to show them your new kitchen renovation. The machine decides you are underwater and the machine cuts the rope. And it's not just HELOCs. We are seeing a quiet contraction in unsecured lines of credit, and credit cards too. Have you checked your credit card limit lately? Some viewers are reporting that their limits were quietly lowered from $20,000 to $5,000. The bank will say it's for your protection. It is not. It is for their protection. They are terrified that if you lose your job in the coming recession, you will max out your cards and declare bankruptcy. So they are taking the credit away before you can use it. This is the liquidity trap closing in. In our previous videos, we talked about how hard it is to get cash out, bail in. Now, we are seeing how hard it is to get credit in. You are being squeezed from both sides. The implications of this HELOC recall are catastrophic for the Canadian economy. The wealth effect is dead. For a decade, Canadians felt rich because their houses were ATMs. They bought cars, boats, and vacations using home equity. That spending fueled the economy. Now, the ATM is out of order. When the bank freezes a HELOC, that household stops spending immediately. They go into survival mode. Consumption collapses. This creates a feedback loop. Less spending leads to business closures, which leads to layoffs, which leads to more mortgage defaults, which leads to lower house prices, which leads to more HELOC freezes. It is a death spiral, and we are just at the top of the slide. There is another, darker legal threat lurking in that demand loan clause. While most people are seeing limit reductions, the bank can legally demand full repayment. Imagine receiving a letter giving you 30 days to repay $50,000. If you don't have the cash, then the bank can force the sale of your home to recover it. But they wouldn't do that, you say. That would crash the market. They absolutely would do that if they are facing their own solvency crisis. If a bank is desperate for liquidity, they will call in loans. They will sacrifice you to save themselves. We saw this in the 1990s recession. We saw it in the US in 2008. Commercial loans are already being called. Residential loans are next. And what about the investors? The BRR strategy, buy, rehab, rent, refinance, repeat that every YouTube guru preached. It relies entirely on HELOCs. Investors use the equity from property A to buy property B. They built houses of cards on a foundation of callable debt. Now, the banks are calling that debt. An investor with 5 properties and 5 HELOCs is facing a nightmare scenario. So if the bank freezes the lines, the investor cannot pay the negative cash flow on the rental units. They are forced to dump all 5 properties at once. This floods the market with inventory, driving prices down further, which triggers more AVM downgrades for everyone else. This is why the spring market of 2026 will not be a recovery. It will be a liquidation event. The sellers won't be selling because they want to move to Florida. They will be selling because the bank cut off their credit and they have no other choice. So, how do you know if you are next? First, look at your utilization rate. If you have a HELOC limit of $100,000 and you are using $95,000 of it, you are a high-risk target. The bank sees you as maxed out. They are likely to freeze the remaining $5,000 to prevent you from getting deeper into debt. Second, look at your credit score. Banks are now doing soft checks on credit scores monthly. If you missed a payment on a cell phone bill, or if your credit card utilization spiked because of inflation, your score drops. That drop can trigger a HELOC freeze. The system is hypersensitive right now. Third, look at your neighborhood values. Are for sale signs sitting on lawns for months? Are prices in your area dropping? If so, the AVM has likely already devalued your house. You are walking on thin ice. The psychology of the borrower is changing. We used to view the bank as a partner. Now, we must view the bank as an adversary. They are not there to help you through the hard times. They are there to extract interest during the good times and cut you loose during the bad times. And this credit freeze is the silent killer of the middle class. You won't see it on the evening news because it happens individually, privately, behind the login screen of a banking app. It is a silent epidemic of financial asphyxiation. But the aggregate data tells the story. The money supply, M2, is contracting. Credit growth has stalled. This is the hallmark of a deflationary depression. The banks are pulling back. And what is the government doing? Nothing. In fact, the regulator, OSFI, is encouraging this. They have implemented stricter capital guidelines that force banks to be more aggressive in managing risk. The government wants the banks to survive, even if it means the homeowners do not. This brings us back to the concept of asset protection. If your financial survival plan relies on access to debt, you do not have a plan. You have a vulnerability. In a credit contraction, debt is not a tool. It is a weapon used against you. So, what should you do if you receive that notification? Step 1. Don't panic, but act fast. If your line is frozen but not recalled, you are in the gray zone. You can still pay down the debt, but you can't borrow more. Adjust your budget immediately. Assume you will never have access to that credit again. Step 2. Diversify your banking. If you have your mortgage, your checking account, your savings, and your HELOC all with one bank, you are fully captured. They see everything. If they freeze one account, they can freeze them all. Ideally, keep your operating cash at a different institution than your debts. This prevents the right of offset, where a bank can raid your savings account to pay down your frozen HELOC. Step 3. Audit your liquidity. We keep saying get liquid. This is why. If you have $20,000 in cash in a safe or a separate account, a HELOC freeze is an annoyance. If you have $0 in cash and rely on the HELOC for groceries, a freeze is a catastrophe. You need real, unencumbered money. Step 4. Prepare for the call. It is unlikely for most, but possible for some. If the bank demands full repayment, you need a plan. Can you sell the car? Can you sell the cottage? Can you get a private mortgage at a much higher rate to pay out the bank? Know your exit strategy before the letter arrives. The HELOC recall is the next phase of the Great Devaluation. It is the phase where the theoretical loss of equity becomes a practical loss of purchasing power. It is the moment when the bank stops pretending that house prices will go back up. They know the truth. They know the collateral is damaged, and they are rushing to the exit before you do. Check your account today. Check your limit. If it's still there, don't take it for granted. It could be gone tomorrow morning after the nightly batch processing of the risk algorithm. We are witnessing the end of the era of easy credit. The bank of mom and dad is tapped out. The bank of home equity is closed. You are now standing on your own 2 feet. Do not let the silence of the freeze fool you. The machinery of the bank is working overtime to protect itself from you. Subscribe to Canada Property Watch. We will continue to expose the tactics banks are using to deleverage the Canadian economy at your expense. We are the only channel telling you to check your credit limit before it hits 0. Stay vigilant, stay solvent, and stop relying on the bank's money to live your life.